All right, let's try this again. Sound? All right. Sounds good. All right. Yeah, my mic's been acting up. Sorry, gang. All right, we're good to go. So, if you're taking a look at what's going on in gold and in, um, there we go, in gold and in gold miners, if you haven't put this on your watch list, please do. We're seeing some really good movement in metals and mining. We're seeing some really good movement in gold miners. So, if you're finding yourself frustrated with potentially where to look, one of the things that is very much a part of any watch list building, especially in an environment where we're trying to find trends, preferably uptrends. I know, Rob, the markets are in chop. The indices are in chop. There are a number of symbols. There are a number of sectors that are moving very nicely because remember, gang, write this down somewhere. There's always an uptrend because money never just goes under the mattress, right? It's going to flow somewhere because everyone's looking for a return. We might lower our expectations for return, but we're still going to be looking for some sort of return. So keep an eye on the normalized performance, and it will definitely be your North Star as far as what you want to focus on. So take a look here, your top five, even your top four, three, right? Gold, regional banks, financials, and then come the miners. So keep an eye on those sectors. In fact, if you haven't already checked out yesterday's free video, I know most of you are on YouTube, whether that be my YouTube or the Simpler Trading YouTube. Yesterday's free video, I walked through that watch list process in a lot of detail. Most of the time, there's two things I find. If you're struggling to grow your account, right? Notice I didn't say if you're struggling to find winners. If you're struggling to grow your account, it's for one of two reasons. One, the watch list building is not the most robust part of your trading plan. And two, it's going to come back down to position sizing and risk management, which in an environment like this, yeah, you can kind of reduce the horsepower, so to speak, behind the trades. Now, another thing to discuss here this morning, and I know a lot of you are already seeing it, we had some data today. We had the core CPI. Powell yesterday really didn't lower the boom on equities the way, say, he did when he shifted the messaging back on December 18th. So fast forward to February 11 and day one of the Humphrey Hawkins testimony. Day one is in the Senate. Day two is in Congress. And what you've got here is today's CPI data. I would normally say day two might be a snore fest because whatever the senators ask, Congress is not going to be asking anything, give or take, that much different. But in the wake of this CPI, this day two with Powell is usually, and you see here I put in the notes, is usually not as volatile, but today's CPI could change the kind of questions and maybe the messaging around today's testimony. Day two starts at 10 a.m. So normally I would say, okay, it's back to normal. No, in fact, you can see bonds are moving lower, which means yields are moving higher. We'll take a look a little bit later on at what the Fed fund futures are doing. Are we seeing a lower probability for two rate cuts this year? And maybe even the one rate cut could be under some pressure. We'll see, because one rate cut has been thoroughly expected and discounted, priced in, so to speak. But two is on the bubble. And today's CPI might definitely disrupt that. Why did today's CPI create this much volatility? Look, I'm not necessarily concerned about the actual numbers of the CPI as much as I am the reaction to. Now, when we circle back to this, as we all will eventually, because data matters, you'll see that the core CPI ticked up by 1/10. The CPI kicked up by 2/10. Now, what's the difference between the two? Anything that's core, doesn't matter what the data release is. Core means we've removed something, right? And in this case, core was the removal of food and energy because, nobody needs that. And if you include food and energy, bam, 0.5. That's why we're selling off, because equities hate the idea of fewer rate cuts. Equities hate the idea of a shorter hold time at these lower rates. Because remember, it's not all about cut, then hike, right? It's cut, hold. How long is that hold going to be for? Now, yesterday, we had one of the FOMC members, I think it was Hammock, who said, no, we're going to hold for a while. And the equity market's like that, because if we're not going to get more cuts, at least leave the rates low, and equities will, obviously benefit. So today's CPI, hotter is bearish, and that's exactly what we've got. But let's step back for a moment and let's avoid all the alarmist talk, because I'm going to be frank, the data supports it, the trends support it, my account growth supports it. It still pays best consistently over the long haul to be a bull, right? If you want to be on television, be a bear, be an alarmist. If you want to actually sit quietly, this is my home office, find good trades, it's still going to pay to be a bull. And we are not in a downtrend on the S&P. This is just, look at the DPMRs. Except for these really volatile days, specifically the 3rd of February and the 27th of January, the rest of the time so far, over the last, say, 4 weeks, we've been holding really well in the volatility zones, which means even though we're not in a trend, volatility is not really abnormal. Volatility being measured by what is the typical price movement range we could see in any symbol, and are we consistently and dramatically exceeding it? And really we haven't been. All right, we haven't been. So we always go by data, right? Notice I'm never saying, at least I try not to. It's actually two words I try not to say. I think and I feel, right? I'm not writing poetry here. This is not about feelings and thinking. This is about what is the data saying, and does price support my hypothesis? So if we jump on over here to the target rate probabilities, look, March was never on the table for a cut. May really wasn't either, and nothing's changed there. June was at best a maybe, but it was really by July that there was a higher probability of a cut. We're losing that, right? Very slowly, that hold column, which is the 425 by 450, this is data, gang, right, is now starting to slowly inch away from the cut. We got to September. September now becomes a little bit better than a coin toss. And then when you go out to October, again, nothing, a little bit better than a coin toss. Coin toss meaning favoring that quarter point cut. Now you got to December. I know it's February, but remember, the market is always, any market, gold, bonds, currencies, indices, metals, they're all forward looking. They're all thinking, what's going to happen and how do I position myself for that eventuality? It's actually only in December, does it seem, the Federal Reserve might give us that one more quarter point cut. So we're going to be in this, based on the data, we're going to be at this 425 to 450 level in the Fed's rate for probably most of the year. So that's summer. Now, granted, the next CPI, if it comes in cooler, all this will readjust, because that's what we do. All right. So again, what I think, what I feel doesn't matter. What do we see? We trade what we see. Yeah. It's not my job to front run data. It's not my job to front run what's going to happen. It's reacting. Gang, we're all counterpunchers. Let the market throw the first punch, we'll react, right? Let the pitcher throw the ball, we're the batter, right? So if you're struggling and you're trading, we're not sitting around with our crystal ball. I think Charlie Munger said it best. I think it was Charlie Munger. I can't remember who, but it was a great quote, which is, if you're using a crystal ball, all you end up with is a mouthful of glass, right? So the data shows volatility is actually pretty darn stable. Typical price movement ranges, where we are 68% of the time, is holding far more often than not. And we're in a lot of chop, and might I add, bullish chop at that. So could I be looking at long SPY calls later on today? Absolutely. Absolutely. The trick in this environment is going to be right? Please don't buy into higher highs unless there's a really strong trend. Gold is allowing traders to do that. Palantir might be a really good example of that. But for the most part, if something's in chop, really important to click into overbought, oversold mode. Wait for things to go oversold, then look for those long calls. And today might be that opportunity, okay? So that's where we sit here at 9:10 a.m. Eastern this morning. All right, so let's see what we've got here. Let's see. Mike, I appreciate that. We can't, and thank you, Mike. Mike says you do such a good job at explaining things. Mike, I'm explaining things to me. Who's read any books by Richard Feynman, the physicist? If you can't explain it basically to a child, you don't really understand it. And could I explain those columns in the Fed fund futures to essentially an 8-year-old, probably. Yeah. So if we can simplify our analysis to remember a few things, the only macro that matters is the Federal Reserve. And we trade what we see, not what we think. And what we see should be the 4 factors that move the market. There's only 4 things that move the market, really. The reaction to news lands in these 4 things. The reaction to geopolitics lands in these things, which is price, of course, time, volume, volatility. We can always focus on those 4 things. It'll tune out the noise. And that's really what we try to do in the Sector Secrets Mastery, right? Over 35 years, I've been trading. And the one thing I can tell you for sure is there's more noise than ever. There's more information than ever. There's more opinion than ever in this trading world that you and I exist in. But the one thing that hasn't changed are those 4 factors. So tuning out the noise is harder than ever. But I will also say, in the same breath, being a retail trader has never been better. The access we have to information, as long as we can be very focused on what we're focusing on, the information available to retail traders, if you know where to look, has never been better. So check out the free video that I did yesterday. That is absolutely my blueprint, right? My framework for what am I going to trade and which direction am I going to trade it. Anything else really is noise. So I appreciate that, Mike. You know, so much of this conversation is just for me too, right? For me to stay on track. And then I love talking to a few hundred of my closest trading friends to say, hey, this is what I'm looking at. And, you know, see if it works for you. Take what works for you, leave what doesn't. And I'll just continue to be talking about, well, my book. What are we actually doing? Not my opinion, not my analysis. And this side of the mic, this side of the camera, my job is to talk my book. Rog, what are you in and why? Yeah, so I appreciate that. What about CFG? This is a bullish chop market, Jess. Wait for that lower half, lower quarter in between the range of, call it 49.90 and 45.50. Wait till we get to that lower quarter, maybe that lower half of the range. And in that range, I would buy a call. I'd say 46.55, 46.56, where this anchored VWAP is at, could be an interesting place to buy an oversold, to buy sort of a dip, if you want to call it that, for something like CFG. All right, Jawan asks, good morning. Can I check on Intel, Oracle, and SMCI? Okay, let's do that. By the way, the 3 time frames that I've got on the screen right now are the only 3 time frames that we have to be bothered with in the mastery. 5-minute time frame, the 5-minute chart for day trading, the 1 hour for short-term swings. I'm going to talk a little bit more about this because I think the shorter, what I'm seeing, I still see, I think, but this is based on what I see. What's happening right now is we're getting 1 or 2 days of a move and then we pull back. So shorten the time duration. That's what I'm seeing. Therefore, that's what I'm going to be doing. And if you're out there going, Ron, I'm not sure which time frame I want to focus on, shortening the duration or going out to a weekly seems to be a pretty good place. In fact, in today's webinar, I'll be sharing not only a number of short-term trading examples, day trades, but I'll also be sharing 2 of our recent long positions in our position trading portfolio. If you've got a longer time horizon, 6 months plus, this is not a bad environment either. I'll be sharing some of those examples today, how we're long things like Coke, how we're long things like Google from months ago, right? And there are things that are strong if you're also looking at that longer term time horizon. So Intel, in terms of what I would want to do with this is chop. I would actually say Intel is not on my list, Jawan, but Qualcomm would be. As far as Oracle goes, again, not on my list for a daily time frame or, frankly, a short-term 1 hour swing. 1 hour, actually, I would be bearish. I would be bearish on that. If you watch the video that I cut, and those of you that are members of the Sector Secrets Mastery and of Simpler Trading in general, I did the premium video yesterday too. And I really just unleashed a kraken on that, where I went through where the trends are. And the list of trending symbols is enormous considering how much the broader averages are chopping. It's just, you're looking in uncommon places. You're looking in places where if you turn it on the television, that's not what's being discussed. If you're looking at most trading discussion obsessed with the Mag 7 and what the NASDAQ and S&P are going to do next, that's not where the clarity is right now. So check out the premium video for sure. I lay out the total sort of blueprint, if you will, of, hey, here's where to look and here's why. And none of these are trending. So Joanne, some of them might have really good setups, but in terms of what would land on my watch list, I wouldn't say those three are on it. And if we can all just agree to say, hey, you know what? Let's find those trending names. Let's find those places where there is a really good uptrend. I'm telling you right now, gang, one of the things about account growth that isn't talked about enough is what you trade is more important than how you trade it. And if what you trade is most important, find the uptrends. Let's reminisce for a moment about 2020. What made 2020 so great? 2020 went up went up, if you want to look at it this way, went up sorry, bot's telling, what are you telling me, bot? Oh, House. Did I say House instead of Congress? Did I say House or Congress? Yeah, House and Senate. Today he's speaking to the House Financial Services Committee. I was just sorry. I was reading what bot was telling me. Yes, I said Congress instead of the House. So yesterday was the Senate. Today, Senate Banking Committee. Today's the House. All right. Okay, so if we're looking at MU, and if we're looking at any way to grow an account, would MU fall into the category of an uptrend? It wouldn't. Would MU fall into the category of bullish chop, which would be a second tier, not top tier, second tier watch list? It wouldn't. So please, gang, if there's something you're focusing on and you're watching this show, right, our number one job is to find those uptrends, and they're out there. So I would have no setup in MU, even less so than something that's in bullish chop, because bearish chop has a lower probability of moving higher. Again, probability, right? Not could it, it's would it. Is it more likely to? And that's where we have to say that 2020 was great because everything was moving up. That's the reason we loved it. So why not find little pockets of 2020 in your trading? Yeah. Okay. Could I explain prop dots? So imagine, Stephen, a smart, self-correcting moving average. Moving averages I love moving averages, especially exponential, but they're kind of obnoxious. They're kind of know-it-alls. They always think they know where something's going. And one of the reasons I like to have prop dots in lieu of moving averages on my chart is because prop dots say, look, we've lost the trend, and in a trend, moving averages are less effective. In moving averages and trending, in a moving average discussion, if we're trending, fantastic. Simple, exponential, whatever. They're great. But when we lose the trend, they really lose a lot of their effectiveness to identify support and resistance. So prop dots say, I don't know the answer all the time. I'm going to shut off when I should shut up, right? And moving averages just don't know how to shut up. Prop dots do. And that's probably their biggest difference. Yeah. And we have prop dots for the tops tools, but if you're looking to use what I'm using now, which is a necessary evolution of the kind of participation we're seeing in modern markets, and I say modern, I mean this shifted probably in 2020. There were two major shifts in market behavior. If you're wondering, yeah, Rob, why do I need to look at the market differently over the time of being a trader? For 35 years, I can see the evolution of once upon a time, 35 years ago, price patterns, great. And then I started adding time. Well, gosh, certain times of year tend to move in certain ways. Okay. Started adding macroeconomics. Gosh, the big trends we have are usually supported by an accommodative central bank. All right, then fast forward again. So throughout 35 years, where I am now is find the trends and find tools that since 2008, when we had a market shift in behavior, and ETFs really started becoming far more influential. And then fast forward 2020, retail participation has never been greater. And it once again changes the way that I look at price alone. I start to overlay, more information. What's behind price? Was it 10 contracts traded at a certain price, or was it 10,010? We know that size does equate to a more important level. And the best way to do that are things like volume weighted average price and volume histograms that look at how many contracts or shares were traded at a specific price, not at a specific time, right? And these are very easy shifts to make for a trader who has a basic knowledge of, your candlesticks and market behavior, but thinking, gosh, I'm I'm losing out on certain nuances. Why did this not continue? This thing that I thought was bullish. Why did I think that we were going to break out and keep going? Right? Those are small nuances. And if there's anything that I say that we have specialized in sector secrets, I kind of call it trader repair. How do we take some really hardworking, earnest traders who put in the effort and said, Rog, I've got a basic understanding of trading, but I know there's some pieces missing, right? And by going in and adding these other factors, whether that be time, whether that be volatility, volume, all of a sudden the things that you knew that weren't working as well as you thought, now they start working really well because it's just a small little bits of things, right? Trade the data, apply critical thinking. Exactly, Meb. Exactly. Yeah, I could not agree more. And that shift, and even Stephen, your question with the prop dots. Hey, I like moving averages, but they don't always seem to have the right answer. Sometimes they just really aren't as effective. Then they're really effective, and they go back to not being effective. That's that nuance with trends versus not trending environments. So I hope some light bulbs are going off, and if they are, let me know. But it's these small tweaks. I think a lot of traders get intimidated by thinking there has to be this grand upheaval of what they're doing as a trader to become consistently profitable, to grow that account. And I found that's not true. It doesn't have to be that painful. It really is just small nuances of what you know and applying them in a better way. So yeah, of course, Stephen, my pleasure. All right, Bob asked, is the short-term bottom in Tesla in? Well, let's see what we've got. Let's see what we can see. It's already down 30% from the high. How low can it go? Bob, I'm always going to say the two levels that I'm certain of are 0 and infinity. But things can go up to infinity, things can go down to 0, but 0 isn't the number anymore either, right? My crude oil traders from a few years ago, you remember when crude went negative. That was unbelievable. Talk about things that I've not seen in 35 years. That was unbelievable. Back to the real world, 0 and infinity, right? So I'm never going to say something's put in a bottom until the patterns show that size is stepping in and the price patterns are reflecting that pause and the weakness. And then I'm starting to see more stable, neutral action after a prolonged period of bearishness. Things don't always turn on a dime. V bottoms, right? That bottom where we're going down, and then we start to move sharply higher are almost exclusively, I can't think of an exception. They're almost exclusively, it's Federal Reserve shifts in monetary policy. So if you go back and look at any V bottom, think of the V bottom in 2019, think of the V bottom with the pandemic, that was Federal Reserve action. So barring that, I'm going to have to wait for what I like to call is a W pattern or a 1, 2, 3 pattern. And that's going to take anywhere from, on the shorter end of the curve, say 7 to 10 days, sessions to establish itself, to maybe up to 3 weeks. So the bottoming pattern, I think a lot of times what I've observed is traders will presume a bottom is in far sooner than it really is, which is not always going to work out well, because a trade is, can you sit through unrealized losses on the way to a target? And that's something that a lot of traders don't think about. In other words, if you're willing to put on a trade, how much are you willing to let go against you price-wise before you say, I got to let this go? Because being early is the same thing as being wrong, right? And I think to try to pick a bottom here would be early, and I wouldn't do it, because let's say it goes to 320. That might be tolerable, $8.50 lower, right? Let's say it goes to 300. Can you still hang on? And then the question is, well, Rog, yeah, I can handle $20 against me in this position, for buying shares, for example. But what risk to your account does that mean? Are we risking 5%, 3%, 10%, 15%? And I'll tell you right now, and I see this very commonly, traders will typically keep adding and risk 10, 12% of their account. So that's being okay with a $10,000 account coming down to 9, or a $100,000 account coming down to 90,000. And those are actually untenable, unscalable risk reward parameters that hurt traders over time. So it's not, will I be right eventually? It's how long can I be wrong? And one of the reasons, oh my gosh, it's 9:25. I got to go. But one of the reasons I absolutely detest the message that the Big Short movie started to plant in traders' minds is just put on the hero trade, right? If you remember the movie or if you've read the book, you know that, say, Michael Burry was down, 20 some odd percent in that account on the way to be really, really right. So now we think, well, it's YOLO, right? Just keep going because eventually you'll be right. But if you also remember, he had to lock out his investors to keep them from withdrawing their funds in order to hang on to this position. And I think that's just set such a terrible precedent in traders' minds for what they're willing to do and how much pain they're willing to take if that is going to go in their favor. I mean, imagine if that housing crisis didn't happen in time. The fund would have blown up. And really the movie that should have been made are all the funds that were just laying on the side of the road, right? Obliterated because they couldn't handle the risk to ultimately the reward. All right, gang, I got to go. Wow, that 27 minutes flew by. Thank you so much as always. And by the way, I'm amped up because we're going to be starting. I'm going to tell you all right now, we're starting an immersion next week. And if you haven't checked out the webinar that I did last week or the one I'm going to do today at 2 p.m., come check it out, right? If you love charts and coffee this morning, you're going to love that webinar too. You can register at simpletrading.com/consistency. All right, gang, be good to each other. I'll talk with you soon.